Inflation has been a more powerful driver of movements in PEs than interest rates. So we've looked at that and sort of married it up with the sentiment. I mean, if inflation is driving the sentiment, if Fed narratives are driving the sentiment, and they're also driving inflation, it's just sort of an interesting synchronicity, I would say, between the two. And if you're just looking at the post-GFC playbook, I think you're really missing what's going on right now.
Welcome back to Strategic Alternatives, the RBC Capital Markets podcast, where we uncover new ways to raise capital, drive growth, and create value in an ever-changing world with insights and outlooks from our capital markets experts. That was Lori Calvasina, head of U.S. equity strategy at RBC, speaking on the Meb Faber Show, a podcast focused on the craft of investing, about how the U.S. market has become more sentiment-driven in the post-COVID era and why investors should be cautious about relying on post-global financial crisis or GFC playbooks in a more inflationary environment. Today on the program, we listen to segments from that podcast and get more of Lori's take on the setup for small cap stocks, the election, the 2025 equity outlook, and much more. Now, let's dive into the conversation.
Lori, welcome to the show.
Thanks for having me.
I want to start with something you've written about, which is we're still in the early days of the post-COVID era of investing. What do you mean by that?
So as we've come out of COVID, we've come out of this 2020, 2021 period. In a lot of my work, I've just thought about, do prior relationships still exist? Should we still be using the same post-GFC playbook for investing, whether that's coming up with things like valuation forecasts, looking at what drives sectors? And I remember really seeing around the GFC period, there were certain indicators that used to drive sector performance that stopped driving sector performance in the post-GFC period. And that was always just a lesson to me that just because a relationship has existed for 5 years, for 10 years, maybe even 20 years, is it necessarily going to endure going forward? That premise is something that's really formed a lot of what we've thought about in the last year or so, a lot of what we've talked about. And where it really hits home is thinking about, one, the valuation discussion, what kind of multiple does the market deserve to trade at? But also just conversations about the resilience of the economy and why it's constantly surprising to the upside and why we frankly haven't seen, sort of a double dip recession that a lot of people have been looking for.
What indicators do you track and how do you gauge sentiment today here in 2024?
The sentiment indicator we're really focused on right now is the weekly AAII survey. And this is something that's really widely followed on the street. What we look at is the net bull. So not just whether you're bullish or bearish, but what's the balance between the two and how stretched is it? We also do back testing to see how worried should we be about different levels. And what's been really interesting over the past year or so is that when you hit the one standard deviation mark, so you're one standard deviation above the long-term average, and that's around, I think, like 22% right now in terms of net bullishness, we have seen some pretty significant pullbacks occur. And so we really try to look at that data, marry it up with what we're hearing. And what I'm really seeing is that the Fed sentiment is just oscillating like a pendulum. It is just going back and forth, +1, -1, +1, -1. And it's got a lot of investors, I would say, extremely frustrated. It's fascinating and somewhat concerning to see how quickly the sentiment can change. And often, I think, frankly, some investors are mishearing some of the things the Fed's been saying and then kind of running too far in one particular direction. And then we stop and take a breath and run back in the other direction. So investors talk a lot about whiplash, and we can really just see evidence of that in this data, and we can hear it in the conversations as well.
Let's dive into valuations. What are the key variables you guys look at today that are influencing where the market should be valued at?
I think the debate I have gotten sucked into over the past year and a half, and it's one that a lot of my clients talk to me about, is what kind of multiple does the market deserve to trade at? I found that there's sort of this tendency among a lot of people, and I think it's a function of when a lot of people came into the business, to be honest. There's post-GFC models going around, and that was really a wacky monetary policy environment. We had very weak GDP, we had very low inflation, we had very low interest rates, but there are a lot of people who are just looking at forward PE multiples based on analyst earnings, which are subject to a lot of variation in and of themselves. A lot of people were like, well, the bond market is telling us, based on where the 10-year treasury yield is, that the PE needs to be 15 times or 16 times, and it's not. It's up here. Equity market is wrong, and the bond market is right. And we sort of took issue with that. I'm an equity person. I don't assume that the bond market is always smarter than the equity market. I think maybe sometimes one thing can be sniffing out something that the other can't figure out. But we sort of challenged that idea of just looking, in this post-GFC world. And I had been tinkering around with a model. We now publish it regularly in the weekly, but it was based on trailing PE data that goes back to the 60s. And I just happened to have a time series that goes that far back. I can't get forward PE data that far back, but I just spent a lot of time trying to figure out what macro variables explain these movements in the PE. And after sort of a lot of testing, I got a lot of inspiration from talking to investors about what they thought should be driving the PE. We found that inflation, if you look at PCE, very, very inversely correlated with that trailing PE. Interest rates are as well. If you look at Fed funds, if you look at 10-year yields. And I realized that in the 70s, when we had this really, really intense inflationary environment, that inflation did a bit more to explain the movement in PEs than interest rates did. And if you look at that data, post-COVID, when again, inflation has been the main thing we're all focused on and kind of driving all other calls, guess what? Inflation has been a more powerful driver of movements in PEs than interest rates. And it was just really fascinating to sort of look at that data. So we've looked at that and sort of married it up with the sentiment. I mean, if inflation is driving the sentiment, if Fed narratives are driving the sentiment, and they're also driving inflation, it's just sort of an interesting synchronicity, I would say, between the two. So again, if you're just looking at the post-GFC playbook, I think you're really missing what's going on right now.
So given all that, do you think the market's fairly valued today?
We have the pleasure as strategists of trying to guess where the S&P 500 is going to end up on December 31st of any given year. So we're at 5,300 right now. That's my target. And as we're speaking here today, that's basically where the market's been hovering, plus or minus a few points. And what we've been telling investors over the past week is we certainly do not feel bearish. We really don't feel like we belong in that bearish camp. I think the bearish camp is looking for a recession that essentially already happened in 2022. And we've basically been in a very misunderstood recovery over the past kind of year and a half or so. And as we think about the math around the market, the math is really telling me that we're fairly valued right now. And so if we are going to justify a materially higher move in the market, we need new information. What could that new information be? It could potentially be inflation moderating more than we've anticipated and that we've baked into our models, getting more Fed cuts than what the consensus is currently assuming. Our model on valuation basically leverages the current consensus views on inflation, interest rates, and the Fed, and it's baking in about 2 cuts right now. So are we going to get something more than that? We're baking in, I think, E going to 2.6 at the end of the year. Are we going to get something more significant than that kind of deterioration? At some point, this market is going to stop thinking about 2024 and transition to 2025. And right now, there still seem to be a lot of clouds and a lot of fog in sort of the investor outlook. And that's not to say that those are necessarily storm clouds, that there's something nasty around the bend, but it is just a little bit hard to see what 2025 really looks like when you've got an election, you've got uncertainty on the Fed, and we've also got GDP forecasts that are sitting down at below trend type levels for next year.
All right, we're sitting here less than 6 months from the election. I'm watching the betting markets for the changes in who seems like they're going to win. What are you thinking about the upcoming election and how the different outcomes may impact financial markets?
I won't make any predictions, but look, I think the reality is that if you take a step back, stocks tend to go up under any combination of political leadership. We've got some good data in this. And there are certain scenarios where it goes up a little bit more than others. It's hard to argue that that's because of the political leadership or some quirks of things that were going on in the economy at that point in time. But generally, stocks find a way to price in change. They don't necessarily like change and uncertainty at the beginning. And so if you look at the beginning of a presidential election year, you typically see some sort of sell-off during the first half. And you tend to rally back over the summer. That's usually when the conventions are happening. You have the candidates settled. You know what the policy agendas are more or less going to look like. And you tend to see the market rally back and then get a little bit choppy around the election and then have a relief rally kind of once it's all over. Now, is it necessarily going to go that way this year? I don't know. This is sort of an unusual election. We've got 2, essential incumbents that voters are pretty familiar with already. And there's also, I think some opacity in terms of the policy that might come out. I think that's something U.S. investors are struggling with a little bit about. What would either of these candidates actually do that the stock market would really kind of dig its teeth into? So we actually did a survey of our analysts back in April, and we went to all of them and we said, if you get a Democratic sweep or Republican sweep, if you get Trump or Biden winning with a split Congress, what's the impact on the outlook for your industry in terms of information available to you today and policies specific to your industry. There are very few people picking an extreme position in any scenario that we gave them. The Democratic sweep generally elicits the fewest bulls, but even there, the bears only number about 17% of the total. And it tends to be sectors that I think would be top of mind, areas like energy, healthcare, that tend to have the most extreme views from our analysts in terms of whether there will be bullish or bearish scenarios. But even then, they tend to be in what we call the +1 or -1 camp. So they're not really looking for very bullish or very bearish outcomes. So I don't think there's necessarily a lot to do if I'm a trader, if I'm trying to make these big sector calls on this short-term event. And if anything, I'm sort of hearing from U.S. investors over the last month or two, they're not looking to really make big trades right now. I think they're trying to be aware of the event, aware of the implications it might have for their portfolio, but I don't think there's an itch to really do a lot. Non-U.S. investors is very different. They've been talking about this since last summer. You mentioned the betting markets. They were the ones that first alerted me to the fact that RFK Jr. was starting to make a move in some of these markets. So non-U.S. investors very, very focused on it, and maybe perhaps a little bit more focused on some of the foreign policy differentials between the candidates.
So in a previous life, you covered small cap stocks. What's your take on the setup for U.S. small caps today?
We keep seeing signs of life, and they're extinguished very quickly. They're so cheap relative to large caps. They do seem to be unfairly penalized for a lot of things. The balance sheet discussion, right? In this era of rising interest rates, there's been a lot of concern about small cap balance sheets. We've got a lot of data showing, yes, they don't look as good as large caps, but they're much, much better, much cleaner than what we've seen in past cycles. So we think they've gotten a little bit unfairly beaten up on some of these Fed fears. But the reality is that if we think about the concept of conflicting cross currents hitting the stock market broadly, I think that there are particularly strong conflicting cross currents hitting the small cap space right now. I think we've also had an interesting economic tailwind develop. So we've seen GDP forecasts in the US rise to about 2.4% now as we speak for 2024. That's right on the cusp of average. Average is about 2.5%, 2.6%. And traditionally, when you see GDP perk up above average, small caps, cyclicals, value tend to outperform large caps, growth, and defensive areas of the market. So underestimating how strong the U.S. economy was and ratcheting up those expectations, that's really good for the small caps as well. They're really, really fighting back, and it's really impressive, but they just can't get the momentum going. And I don't think they really will until, one, we really break above average on GDP forecasts, or two, we just get the Fed cuts started.
What about value versus growth? Do you spend time on that as well?
It's an interesting question, what belongs in these different buckets, because on the industrial sector, it's got a crazy high PE right now. It's like a 3 standard deviation event on our chart on both like an absolute and a relative multiple. And when we're looking at medians, we're not even looking at cap weighted multiples. So that's your typical stock. And it's as bad as the tech sector. It's just an interesting debate because of the theme of reshoring, of deglobalization. You know, we think these are big mega themes that are in place post-COVID, and they're not going away anytime soon. Is industrials becoming more of a growth sector? Is it going to start trading at more of a growth type multiple? Is it even valid to go back and compare the PE today to the PE over the last 20 years? If it's changing its stripes and moving from more of a cyclical to more of a growth-oriented area, we may be misjudging the valuations and what's really, truly expensive in that area. So I think those are really interesting conversations. And when we think about how that translates into what you do with a portfolio, we say, look, we acknowledge the valuations look pricey, but we're not going to go underweight because of that. It may be tough to take an overweight position with that kind of sticker shock, but we're at least going to stick with sort of a neutral or a market weight position in our portfolio.
You pointed out that earnings per share yield is nearly at parity with bond yields. Is that bearish, bullish for stocks? What's it mean?
If we rewind to 2023, there were a lot of what I would say bad bearish arguments floating around. And I would say that arguments died down. It was something we spent a lot of time talking about last year. And I think, frankly, the fact that we came into 2024 and in the first quarter, we saw tremendous money going into bond funds and we saw tremendous money going into equity funds. And guess what? We also saw a lot of money going into money market funds that I think investors kind of quieted down a little bit because ultimately this would manifest in flows. And the flows just bore out the idea that there's plenty of opportunity to go around and kind of benefit all these different things. Now people look at that cash sitting in money market funds as a source of cash on the sidelines that may potentially come back into equities at some point. Now it is earning a lot, just given where interest rates are. So we might need to see the Fed ease up and interest rates to come down a little bit to admittedly unlock some of that. But I think we've just entered into a different phase this year where people understand it's a little bit more complicated than we were led to believe last year.
You've got some great charts on the concentration of the large names in the S&P 500. Do you think that'll continue, or there'll be a catch-up trade with other names?
If you look at the concentration in the market, and I think there was a lot of concern that we had sort of reached some dangerous tipping point last year. We don't really see that in the data. We see concentration spike at periods when markets are nervous, and sometimes that happens after a crisis, before a crisis, or the middle of a crisis. There's really no rhyme or reason if you go back and look at it. All it tells you really is that there's some nervousness in the market. Now, we have been looking at PE data for the top 10 names in the market versus the rest of the S&P 500. And we've got a fascinating chart that shows if you look at that top 10 cohort, and we rebalance it over time, it's not always the Mag 7, but right now it's got the Mag 7 plus a few other things. You've been trading, depending on which day we update the data, high 20s kind of multiple, right? 25, 26, 27, somewhere in there. And it's kind of bumping up against the pre-COVID ceiling. And you're just not really getting a lot of multiple expansion in there. It's sort of stalling out. The rest of the market's trading around 16 times on a forward PE, so a little bit above average, nowhere near past peaks, and a level that many people would tell you is quite reasonable. I think there's a catch-up trade in the latter part, and that's often what we see coming out of difficult periods is something runs hardest off the bottom, takes a little bit of a pause, and the other thing catches up. So the question is, why would that other thing, what would cause that other thing to catch up right now? And I think it goes back to the idea of earnings growth. Basically, you had about 35% earnings growth in the Mag 7 bucket last year if you treat it as one individual stock. And that growth rate is expected to decelerate this year and then decelerate again next year, I think, to around 14, 15%, something like that. Rest of the market was negative last year, expected to retrace into positive territory this year, and then guess what? Get into the low teens in 2025. So you've got this enormous valuation gap on the PE, and you've got a shrinking gap on earnings growth expectations. And so I see a couple of things in that data. I think this has been a very rational market. The multiple chase the earnings growth, and it's sort of at those lofty levels because of that earnings growth differential we've seen recently. But I also think things are changing. And I don't think investors are really going to play that premium multiple anymore for earnings growth that is less advantageous. I think it is very rational. I think it is very Darwinistic. And I think it's frankly very healthy. And I see investors as I go out on the road, talk to people, it's felt like the last 6 months that Mag 7 bucket has shrunk. If your earnings growth isn't holding muster, if there's some sort of problem in your growth story, you're getting kicked out of the bucket. That's what we want to see. We want investors to be that shrewd and that discerning.
In the last cycle, margins was something that everyone was talking about. There's been talk about whether or not they're going to remain higher forever or mean revert back to long period averages. Do you got any insights based on the recent earnings season?
It's something we think quite a lot about. I'm not sure that we have the magic bullet answer to where they're going. I will tell you that when I look at my earnings model for the S&P 500, it's basically an income statement for the S&P, and we have 5 main line items. One of those is revenues, one of those is margins, one of those is buybacks, one of those is taxes, and the other is interest expense relative to sales. And if I think about those 5 things, the one that gives me the most trouble is the margin line. We're at 237 on earnings for the year. The bottom-up consensus is tracking about 245. And when I look at my model versus consensus, I think that is the big difference. And if I look at the consensus data, it's baking in margin expansion for every sector over the next year or so. So I think that is the big differentiating point. And I'll tell you what we struggle with on margins is that any kind of qualitative or quantitative data point that's explained margins in the past and those trends doesn't seem to be working very well recently, and they keep surprising to the upside. So there's something that's changed, and we've thought a lot about why is the math not working? What has changed? What are these upward pressures on margins? And one of those is the tech sector and the composition of the market. There's just structurally higher margins there. That composition of the market is a little bit different than it's been in the past. So that's one thing. But again, margin expansion is being baked in for most sectors next year. So what's explaining that? And that's where I would say we lean on kind of art more than science and qualitative inputs more than quantitative inputs. I'm just coming to the conclusion that companies are just really good now at managing through crises. And I think they just have a sense that they can work through things, and they're constantly finding costs to suck out and efficiencies to add in. And that's translating into margins. It's really just a thing of beauty to watch, to be honest.
Anything else on the brain we haven't talked about today?
I think that the concept of uneven recovery recoveries is something we've been thinking about a lot lately. And I was looking at some data on consumer confidence at the beginning of the year, and RBC's four main coverage regions on the equity side are US, Canada, Europe, and Australia. So I was looking at consumer confidence metrics for those different regions. And it was just really interesting to me because the University of Michigan Consumer Sentiment Indicator went down to levels worse than a typical recession in 2022. I stumbled across a pan-European consumer confidence indicator, and it also went down to recession-type levels in 2022. And actually, the chart looks broken, but I think it's the war that really sent it down very sharply in a hurry. And then we looked at, and you've been seeing recovery in those indicators since. It's not that the levels are off the chart, but the trend is in the right direction. If you look at Australia and Canada, they took much longer to sort of hit those lows. They've been sort of stuck around those lows. If I look at Australia as sort of a proxy for what's going on in that part of the world, it just struck me that the US feels like that we've just embarked on some sort of recovery a bit earlier than other regions. And I think that's helped the US just in terms of being a safe place to stash money. What I've noticed in recent earnings calls is companies are much more balanced. And these are S&P 500 US-based companies, but their conversations about China are much more balanced than what we saw throughout the past year. If things are starting to stabilize and embark on a recovery in that part of the world, that is where I do think you have to pay attention to flows. So it's not just equity bond, it's also geography within equities. And so if we start to see, maybe that bond pressure come in at the same time that some European pressure comes in or some non-US pressure, that's actually, I think, a bigger risk for equities because I do think the flows into the US have offset some of that pressure you might have seen from the asset allocation shift. And I'll just round that out by saying if you look at European equity flows on the EPFR data, they're stabilizing. They're not positive yet, but they're not getting worse and they're getting a little bit better at the margin. We've seen similar things in Australia and Canada where some of these non-US markets, you're starting to see some early indications of stabilization or return.
Lori, thanks so much for joining us today.
Thanks for having me. This was a lot of fun.
You've been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on June 14th, 2024. Listen and subscribe to Strategic Alternatives on Apple Podcasts, Spotify, or wherever you listen to your podcasts. If you enjoyed the podcast, please leave us a review and share the podcast with others. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.